Real estate has made so many people rich, millionaires, multimillionaires, even billionaires. It's one of the best ways to build wealth. But here's the problem. Not everyone can afford to buy a property. And even if you do, managing it can be a headache. Tenants, maintenance, taxes, it's a lot. But you can invest in real estate without ever buying or managing a single property. You can do that through REITs. REITs, or real estate investment trusts, are companies that own and operate real estate, like office buildings, shopping malls, warehouses, and even apartments. Instead of buying a house yourself, you can simply buy shares of these companies, and they pay you rent money in the form of dividends. Well, at least this is how I can explain it in a very simple way. You will get your dividends from the rental income, but also as those properties included in REITs increase in value in the long term, your shares are likely to be more valuable as well. It sounds very easy and very convenient, but as everything else, REITs come with some pros and cons. Let me break them down here very quickly. 1. REITs usually pay high dividends. Many well-known REITs pay out at least 3 to 4% per year, way higher than regular stocks. You can even find some REITs that has double-digit dividend yield, but be cautious with them. 2. There is zero management stress. You don't have to deal with the tenants or repairs. You will not get a call at 3 a.m. to deal with an issue in your property. 3. REITs are very liquid. Unlike selling a house, you can sell your shares instantly because they are just like stocks, traded on a stock exchange. 4. REITs provide you with diversification. Instead of owning one property, you get exposure to hundreds. In other words, if you lose money in one of the properties, the others will cover your back. But of course, nothing is perfect. You also need to understand the risks of investing into REITs. 1. REITs can be volatile. They are just like stocks. Their prices move with the stock market. One negative news about the economy can affect REITs very quickly. But that should not be a concern if you are a long-term investor in REITs with strong portfolios. 2. You should choose your REITs very carefully. There are dozens of REITs in each sector. Some of them owns only office buildings, some of the only shopping centers, and a great selection of them invest in simple residential buildings, just like the one that you live in. You need to make sure that you choose the right one. Because certain commercial real estate sectors at the moment are going through challenging times, like the office sector. We will talk about that in a different video. Let's not get distracted here. Also, some REITs are over-leveraged, they use a lot of debt, and they struggle in high-interest rate environments. Again, we will talk about how to choose the best REITs later in a different video. 3. Finally, most likely you won't build wealth like you would with a physical property. If you have a lot of capital, you are more likely to earn more by house flipping. But with REITs, that is the price you pay in return for low risk, less work, and less headache. Okay, now you know the secret. You don't need millions to be a real estate investor. You can start with just a few dollars through REITs. But the most interesting part is that I believe this is the best time to start investing in REITs. Now is the best time to be in commercial real estate. Since 2022, real estate has been struggling. Why? Because central banks, like the Federal Reserve, raised interest rates to fight inflation. And when rates go up, real estate prices go down. Let me explain it super simply. Imagine you want to buy a building, but you don't have all the money. You need a loan from the bank. When interest rates are low, borrowing money is cheap, so people buy more buildings. But when interest rates are high, borrowing money is expensive, so fewer people buy. That means fewer buyers, fewer sellers, fewer deals. Real estate prices drop because nobody wants to pay too much when loan costs are sky high. And guess what? It's not just buyers who struggle, developers do too. When rates are low, developers can borrow money cheaply and build new properties. But when rates are high, loans are too expensive, and they stop building. That's exactly what happened. Construction costs are already high, and expensive loans made it even worse. So now, there aren't enough new buildings being built. But interest rates have stopped going up. In fact, central banks, including the Federal Reserve, have already started cutting rates. And it is largely expected that real estate prices will stabilize and start going up again. Let's take a good look at the Commercial Property Price Index published by Green Street. During the pandemic, just like stocks, commercial real estate prices crashed because businesses were struggling, and no one was sure what would happen next. But then, as things got back to normal, prices bounced back super fast and even hit their highest point in mid-2022. Then came the big problem. The Federal Reserve, Fed, started raising interest rates quickly to fight inflation. When that happened, real estate prices started dropping again because borrowing money got more expensive, and fewer people wanted to buy buildings. But here's the good news. By early 2024, prices stopped falling. They hit a low point and just stayed there for a while. And in September 2024, the Fed finally cut rates for the first time, and boom, prices started rising again toward the end of the year. This is a big deal because it means the market is starting to recover, and we're entering a new real estate cycle. Will this cycle be the same as before, or will it be totally different? That's a big question, but we'll save that for another video. If you are in the right sector and the right market, demand is still strong, businesses need offices, companies need warehouses, and people need homes. Supply is low, because nobody has been building new properties. Rent prices are rising, which means real estate investments are becoming more profitable. That's why I think now is one of the best times to invest in REITs. Prices are still low, but they won't stay that way forever. And if you want to invest in real estate without the hassle of owning properties, REITs are the easiest and safest way to do it. Now you might be wondering, how do I actually find REITs? How do I know which ones are the best? Well, the first step is to use a stock screener, basically a tool that helps you filter and find stocks based on certain criteria. There are plenty of options out there, but I like to use finviz.com. It's simple, just go to the site, select real estate in the sector filter. And boom! You'll see a full list of publicly traded REITs. Of course, not all REITs are the same. Some do better than others, and the sector you choose matters a lot. Which one should you pick? That's totally up to you. But before investing, it's a good idea to research which real estate sectors are doing well and which are expected to grow in the future. We'll talk more about that in another video. So, now you know that you don't need to own physical properties to invest in real estate. You can do it through REITs, and it's simple, accessible, and low risk compared to buying properties yourself. In the next videos, we'll talk about how to analyze REITs, which sectors are performing the best, and how you can build a strong real estate portfolio for long-term wealth. So if you found this video helpful, hit the like button, share it with others, and don't forget to subscribe for more easy to understand and informative videos on investing. See you in the next one.